In 2008, the world was hit by one of the worst financial crises in history. The crisis sent shockwaves through the global economy, and its effects are still being felt today. The roots of the crisis can be traced back to early 2000s, when banks were giving out mortgages to just about anyone, regardless of whether they could actually afford to pay them back. Following the dot-com bubble burst, Fed Reserve Chairman Alan Greenspan had lowered interest rates down to 1% by 2003 from over 6% in 2000 with an aim to boost the economy. As a result, the housing market boomed and prices soared. People were taking out mortgages they couldn't afford, hoping to cash in on the rising values of their homes. By 2004, home ownership peaked at 69%. But then, in 2006, the housing bubble burst. Prices plummeted, and many homeowners found themselves underwater, owing more on their mortgages than their homes were worth. The banks that had been giving out these risky mortgages suddenly found themselves in trouble. They had packaged these mortgages into complex financial instruments and sold them to investors all around the world. But when the housing market crashed, these financial instruments became toxic. Investors panicked and started to sell them off, causing a ripple effect throughout the global financial system. Banks started to fail, and people began to lose their jobs and their homes. The crisis quickly spread from the United States to other parts of the world, and governments scrambled to prevent a total economic collapse. In 2007, Lehman had underwritten more mortgage-backed securities than any other firm, accumulating an $85 billion portfolio. Lehman's stock fell sharply as the credit crisis erupted in August 2007. By the summer of 2008, the carnage spread across the financial sector. Over the weekend of September 13, Lehman, Barclays, and Bank of America made a last effort to facilitate a takeover of the former, but that did not work out. On Monday, September 15, Lehman declared bankruptcy, resulting in the stock plunging 93% from its previous close on September 12. Lehman owed over $600 billion to creditors all over the world but were paid only 9 cents on the dollar, crashing S&P up to 45% by September 2008. The Wall Street bailout package was approved in the first week of October 2008 and Fed loaned $7.7 trillion. In December 2008, banks borrowed $1.3 trillion at 0.01% interest. Governments around the world bailed out banks and other institutions that were too big to fail. The 2008 financial crisis was a wake-up call for the world, a stark reminder of the risks and consequences of unchecked greed and recklessness in the financial sector. It serves as a cautionary tale for us all.